Hello everyone, a very good day to all. Myself, Dr. Vibhuti Shivam Dubey, Assistant Professor, School of Management, BBDU University, Lucknow. Today we are going to discuss on a topic which is related with Bachelor of Business Administration course. The topic which we are going to discuss today is on project financing. The topic of project financing is related with the subject of project management BBA 4502. So today we will be discussing about project financing by classifying today's topic of discussion into three parts. First of all, we will be discussing about what is appropriate capital structure. Then we will be discussing about the various financial instruments to be used. And in last part, we will be discussing about financing sources used for a project. So we will take each and every aspect one by one. First of all, we will be discussing about the topic of capital structure. So, as we all know, capital structure is made up of equity and debt. If we opt for equity, which is considered as the owners, they have residual claim on income and wealth. Dividend paid is not tax deductible for equity shareholders. They have definite lifespan and controls affairs of the firm. Whereas if we opt for debt, creditors, they are creditors which have fixed claim on interest and principal payment. Interest paid is also tax deductible. They have fixed maturity on debt. Debt investors plays a passive role and impose conditions also. There are some key factors also in deciding the debt and equity ratio. The first one is cost. Lenders require low rate of return than equity holders and are also tax deductible, while equity is not. The second one is nature of assets. For tangible assets, more debt, example, steel plant use more debt when compared with software companies. The next point is business risk, which includes variation in earning like profit before tax, taxes, assets, demand changes, price variations, input cost variation, proportion of fixed operating cost. The next one is norms of lenders. Normally, financial institutions allow 1 is to 1 debt equity ratio. For high capital intensive projects, financial institutions allow high debt equity ratio. The next one is control consideration. Equity shares that promoter hold is a key factor. Example, in a project costing 5,000 crores, promoter plans to invest 1,250 crores and wants 50% stake in equity. So total equity can be 2,500 crores. Rest has to be debt. Debt equity ratio will be 1 is to 1. And the next point is market condition. In a buy on market equity market, equity can be obtained at high premium. So low debt equity and vice versa. So now we are going to discuss about sources to finance a project. There are different ways on the basis of which classification on sources of finance can be done. Here we will be discussing about only the prominent sources to finance a project. The first one is internal accruals. The second one is securities in the form of equity, preference, debentures, and bonds. The next one is term loans, and then working capital advances, and last, miscellaneous sources. First, we will be discussing about internal accruals. Internal accruals of a firm consist of depreciation charges and retained earnings. Depreciation, it represents periodic write-off of capital cost incurred in the beginning. It is a non-cash charge. Hence, it is considered an internal source of finance. The next internal source of finance is retained earnings, that are the portion of equity earnings which are plugged back in the firm, and it is also an important source of long-term financing. Next is equity capital. Equity shareholders, as we all know, are considered as the owners of the company. They are mainly classified into authorized, issued, subscribed, and paid up capital. Amount of capital that a company may issue is authorized capital. Capital offered by a company to investor is issued capital. Part of issued capital which has been subscribed by investor is subscribed capital, and the actual amount paid by investor is paid up capital. The next one is preference capital. It is a hybrid form of financing with some features of equity and some features of debentures. Preference resembles to equity in the form that preference dividend out of distributable profit, not a obligatory payment. Preference dividend is not a tax deductible payment. Preference capital resembles to debt in the form of dividend rate are usually fixed. Claim on preferential shareholders are prior to equity shareholders. Preference shareholders do not enjoy right to cast vote. Debentures or bonds. It is a variable alternative of term loan, an instrument for debt finance and more flexible than term loans. They are sold to investors through trust rates. Trustee, usually banks, financial institutions, or insurance companies, typically secured through mortgage. Redeemable in nature, may have fixed, usually or floating rate of interest. Next is term loan, generally repayable in less than 10 years, typically employed in acquisition of capital assets and working capital. Term loans are secured borrowings by mortgage hypothecation in restrictive convents. It may refrain from new investment, additional borrowings without prior approval of lender. May ask to repay existing loan. The next one is working capital advances. Working capital advances are provided by commercial banks in the form of cash credits, overdrafts, in the form of loans where interest is charged on full amount, irrespective of how much it is used. Purchase or discount of bills may be payable on demand or after a usage period. The last is miscellaneous or other sources. It is in the form of deferred credits. Here, credit against letter of credit or bank guarantee is given, lease financing, or in the form of hire purchases, unsecured loans and deposits, subsidies and exemptions, securitization, where packaging of a pool of assets and issuing securities. In last, we will be discussing about project financing structure. It can be mainly here discussed in two parts. Full recourse structure, where borrowings are fully secured by first charge on all existing and future assets of the company by way of mortgage and hypothecation. In case of expansion, existing and new lenders acquire rights on mortgage or hypothecation in proportion to amount of finance. Project promoters may be asked to provide personal or corporate guarantee to lenders along with cash flows. Or project financing structure can be in the form of limited recourse structure, mostly for infrastructure finance. Private sector promoter takes a substantial share in project company. Cash flows are handled by independent agents. So today we have discussed about project financing by classifying the topic into four main sections. First of all, we have discussed about the capital structure. Then we have discussed about the main key factors which decide the debt equity ratio, and then in the third section we have discussed about the different sources to finance a project, and in the last section we have discussed about the project financing structure. So I hope you all have gained from today's discussion. Happy learning. That's it from my side.